interesting that he's invested 40% in bullion at the moment, and that he thinks that bullion is currently where the market's at, but that further down the line, more people will be looking to move into gold equities.
I thought it was very interesting to get the perspective of a fund manager and from the financial perspective. My background's in finance, and essentially, to hear what he thinks where gold is going to go, and especially what he said about silver in terms of the outperformance when gold outperforms the market as well.
Cheviot Asset Management is a regular private client style of business, but I'm the crazy gold bug at the end of in the corner of the room who's allowed out occasionally, allowed out of bondage, and I'm very grateful to be able to be here to rant at you this morning, which is probably what you're going to take from this, is just a bit of a wild rant, but hopefully there'll be some detail in there you may not be aware of already. If you're all aware of all of it, I apologise, but them's the breaks. So I should give you a little bit of additional background on Cheviot, just so you understand what that is. It's rather than being a fund, it's a firm with £3 billion under management, various UK-centric approaches and models, and I advise a relatively small still offshore precious metals fund, which is 50% silver and 50% gold. And I'm going to try and give you some colour as to where I think things are, both in general terms about investment markets, but also specifically to the metals. Now let's make sure we get this right. Okay, we are, yeah. Okay, so are you a gold bug conspiracy theorist or a paper bug coincidence theorist? I think you know what I am probably already. I'm going to come on to a specific example of this question. A friend of mine sitting at the back said it can't be black and white, can't be necessarily one or the other, but I would beg to differ. I think really you either accept that there are some things going on which perhaps aren't entirely above board, or you're relatively willing to accept the status quo and go along with that. Right, so let's talk about the markets, because obviously you've all been watching what's going on, probably with as much amazement as me, most of which relates to bailouts, printing money, all these kinds of things which tend to get gold bugs excited and maybe make you think about investing in things which are stores of value. Just run through a number of these points quickly. It appears to be the case across the board now, globally, the way the financial sector is working is to nationalise the losses and privatise the gains. And I think we're all probably of a similar mind that perhaps this is unsustainable, something has to be done about it. And this obviously feeds the mindset of the gold bug and the gold investor, who's taking a view against the government's approach. I've always said that investing in gold and silver is actually a vote against the government, because effectively what you're saying is, I don't trust your monetary or fiscal policy, and I'd rather have my money invested in a store of value. Relating to this 750 billion euro or 1 trillion euro bailout of Greece, you'll note I put here of the German, French and UK banks, because of course that's what it really was. It's a bailout of the debt held by these major banks. And then Angela Merkel came in and put the short-selling ban in a couple of days ago, much to everyone's amazement, consternation, etc. But of course the reason why is because these same German, French and UK banks effectively are going short against the bailout. So you're raising taxpayer money to bail out the debt of the banks. The banks are not necessarily using that specific debt, but at the same time they're betting against that particular bailout. And so there are evidently some serious things going on in the structure of the markets. Some would say it's getting a little out of control. And unfortunately, once you go down this route, the gold bug will say it's a bit of an unstoppable, or rather there's unstoppable momentum to this creation of paper and bailout philosophy. The pigs, I'm sure you've come across this too. Hello. The pigs have debt refinancing needs over the next 3 years of 2 trillion euros. And obviously that's just 5 countries. And it just gives you an idea of the scale of the paper that must be issued, or someone's got to buy that debt. You know, it's not just created into the ether. Either it gets printed or someone's got to buy it. And evidently, you know, the crisis that's emerging on the sovereign side is not going to go away. It is going to rumble on. What the end result of it is, no one can tell you, but be aware that it is moving fast in one direction. Now, this is the point about coincidence theorist versus conspiracy theorist. In the last quarter, 63 trading days, both Goldman Sachs and JP Morgan had a perfect trading quarter, which means that they were profitable on their own prop desk 63 trading days in a row. One market wag reckons that the mathematical probability of that, you're actually 40 times more likely to be struck by lightning than have 63 trading days in a row where you make a profit. At which point I would tend to say to you, if you think about that, and then you also think about the fact that 60%, actually a little bit more than that, of all the volume on the New York Stock Exchange is program trading. Effectively, the people who are making investments in the market, i.e. you and me, are the small part of the market, and you've got a phalanx of investment bank money being transmitted via computer programs and effectively nicking in either side of your trade and making profits on the back of it. And if you look at that, and then you look at that together, to me, if you still believe in coincidences, then I've got a bridge to sell you in Brooklyn, because this is not feasible. You know, you can't think that these two titanic investment banks can have 63 trading days in a row, both of them, incidentally, both of them, 63 trading days in a row, unless you consider there may be something going on which isn't absolutely above board. This is a chart I found a month ago or something. It'll be almost exactly the same as it looks like now. If anything, obviously, this would have descended further. It looks rather complicated, but it's actually very simple, which is diminishing marginal productivity of debt in the US economy. So, in 1970, $1 of debt created 70 cents of productivity for the US economy. And over time, as debt builds up, the actual productivity of debt disappears. Unfortunately, now, we're way down. So every dollar of debt that's added to the US economy does the reverse. And this is why people like Ron Paul and various other market commentators are talking about the fact that you can't bail out debt with debt. Because if it's unproductive, it's clearly not going to have the effect you want. In fact, it will have the reverse effect of what you want. It's